The stock market is currently closed. As of the final bell on Friday, June 5, 2026 at 4 p.m. Eastern Time, Nuburu Inc., trading under the ticker symbol BURUR on the NYSE American Exchange, officially closed at 0.16 per share. This marked a drop of 5.88% for the day, with the stock oscillating between an intraday high of 0.17 and a fresh rock-bottom low of 0.1522. While a casual glance at this penny stock might suggest a company simply fading into obscurity, the hidden reality is far more complex and high stakes than the sub-$1 price tag implies. While the public looks at this as just another dying microcap laser company, institutional entities and international defense players are quietly watching a massive corporate transformation. Nuburu has completely reconstructed its identity, shifting away from standard industrial laser manufacturing to assemble an international defense, security, and tactical platform. The massive divergence between what retail investors think is happening and what the regulatory filings actually show creates an intense backdrop for anyone engaged in online investing today. When regular retail investors look at microcap names on popular investing sites, the general expectation is that a stock trading at 16 cents is a straightforward bankruptcy candidate. The narrative surrounding Nuburu for the past year has been defined by severe capital destruction, a desperate 1-for-4.99 reverse stock split back in February, and repeated warnings from the NYSE American Exchange regarding delisting risks. The consensus view is that the business is flatlining. However, if you examine the reality found inside their latest first-quarter financial filing for 2026, you discover a chaotic, aggressive restructuring campaign. The expectation was a continuous bleed toward a zero balance sheet, but the reality revealed a massive surge in total assets to $76.15 million, alongside an engineering feat that dragged their stockholders' equity out of a deep negative $15.18 million deficit at the end of last year up into a positive $2.17 million. They did this by executing an intricate series of international acquisitions and balance sheet maneuvers that completely altered the company's DNA within a matter of months. To truly understand the recent stock movement, we have to look closely at the intense trading volume and the institutional chessboard playing out over the last few sessions. On June 4th, just a day before the close, the stock witnessed an absolute explosion in trading activity, with over 144 million shares changing hands in a single session. To put that in perspective, that is several times the company's standard trading velocity, driven by a sudden wave of speculation after management announced their new laser arm initiative. This plan specifically targets high-growth directed energy and counter-unmanned aerial systems markets, which is fancy talk for anti-drone laser weapons. The sheer volume shows that individual brokerage accounts and short-term traders are fighting heavily over these shares, causing massive daily swings. One day the stock is up nearly 7% on intense speculation, and the next day it gives it all back as institutional debt holders dilute the float to recoup their cash. It is a classic battleground scenario where the underlying liquidity is heavily impacted by ongoing standby equity purchase agreements and capital raises. The pressure on this stock is fundamentally driven by a ticking clock. The NYSE American Exchange gave Nuburu a strict compliance deadline of October 29, 2026 to permanently restore its minimum equity levels and maintain a viable listing. This specific date is why management is moving at a breakneck speed, swallowing up European technology firms to artificially pump assets onto their balance sheet. Just a few days ago, their subsidiary Orbit announced a $240,000 order framework from a major telecommunications operator in Italy. On top of that, they disclosed a commercial pipeline of prospective offers totaling $825,000. For a mega-cap company like an Apple stock or an Nvidia stock, these numbers are literal pocket change, less than a rounding error. But for Nuburu, which generated precisely $0 in revenue in the first quarter of last year, pulling in $407,000 in consolidated revenue this past quarter is a dramatic shift from absolute zero. Yet this operational progress faces massive macroeconomic and structural headwinds. The capital structure of Nuburu is incredibly messy. To fund this rapid expansion into the European defense sector, they have relied heavily on complex financing structures, issuing millions of shares and pre-funded warrants to institutional funds like Indigo. While retail traders on a casual Robinhood stock trading app might see a headline about a new drone-killing laser contract and rush to buy, institutional players view the stock through the lens of relentless dilution. Every time the company needs to clean up its balance sheet, it convinces preferred share investors or debenture holders to swap their debt for common stock. For instance, they managed to wipe out an $8 million preferred obligation related to the Orbit deal, but they did it by promising to issue 10 million new shares of common stock down the line. This means that even if the business successfully pivots its technology, early investors face an ever-expanding supply of shares that acts like a heavy wet blanket on the stock price. Let us pivot for a moment to look at what this business actually does at its core, away from the stock market madness. Originally, Nuburu built its reputation on a very specific piece of technology, industrial blue lasers. Historically, traditional industrial manufacturing utilized infrared lasers for welding and melting metals. The problem is that metals like copper, gold, and aluminum reflect the vast majority of infrared light, making the process highly inefficient and prone to defects. Blue laser light, however, is absorbed by these non-ferrous metals at a rate up to 20 times higher than infrared. This gives Nuburu a genuine technological moat in specialized manufacturing fields, such as electric vehicle battery production and aerospace components, because their machines can weld copper faster and with far more precision than legacy systems. Their business model has historically focused on selling these high-powered blue laser modules to industrial manufacturers. But selling expensive niche capital equipment to commercial manufacturing giants requires immense sales cycles and massive upfront capital. Because they lacked the cash to scale that industrial business, they shifted their focus entirely toward a dual-use defense and security platform. By acquiring companies like Lyacon, an Italian laser engineering specialist, and securing a controlling stake in Orbit, they are trying to merge their proprietary blue laser technology with advanced beam control and electronic warfare systems. The goal is to create integrated systems capable of projecting optical power over long distances, essentially allowing them to disable hostile drones or even recharge friendly automated assets in midair. It is a highly ambitious business model, attempting to transform from a struggling component manufacturer into an international defense contractor. But looking at the older financial reports reveals just how deep of a hole they are trying to climb out of. The net loss for the first quarter of last year was a staggering $16.6 million, an absolute disaster for a company of this size. This year, they managed to narrow that quarterly net loss down to just under $460,000. On paper, that looks like an incredible turnaround, but if you look deeper into the accounting methods, a massive chunk of that improvement did not come from selling products. It came from non-operating fair value gains on their outstanding warrants and corporate debt. The operational reality is that their operating expenses for the quarter were still a heavy $7.7 million. Cash used in operating activities was over $9 million for the 3-month period alone, leaving them with a cash cushion of just $8.3 million. This mismatch is exactly why management openly admitted in their latest SEC documents that there remains substantial doubt about the company's ability to continue as a going concern. Comment below how many shares of Nuburu you currently hold, or if you prefer sticking to safer megacaps for your portfolio. When you weigh the future outlook for this company, it completely depends on whether their international defense strategy can outrun their impending cash burn. There are 2 distinct paths ahead. In the optimistic scenario, their ongoing strategic acquisition of Techne, a NATO-aligned defense mobility and electronic warfare provider, successfully passes the Italian government's Golden Power review process. If that hurdle is cleared, Nuburu suddenly gains direct access to established European military logistics chains and defense budgets. Their integrated laser platforms could transition from experimental field tests into active procurement contracts, allowing them to scale their revenue from hundreds of thousands of dollars into tens of millions of dollars. If they achieve that before their October compliance deadline, they could satisfy the NYSE American requirements, avoid delisting, and trigger a massive short squeeze as the market realizes the business is no longer on the verge of collapse. Conversely, the pessimistic reality is a highly visible threat. If the integration of these Italian subsidiaries stalls, or if the revenue pipeline fails to convert into hard cash over the next few months, the company will have no choice but to continuously lean on their equity purchase programs. This will flood the market with cheap shares, driving the stock price even lower and potentially forcing another highly unpopular reverse stock split just to maintain a nominal price floor. If they cannot satisfy the exchange's equity demands by October, a forced delisting to the over-the-counter markets would instantly crush institutional interest, dry up trading liquidity, and make it incredibly difficult for the company to raise further capital. For anyone managing their own investments via self-investing platforms, this is the ultimate high-risk asymmetric gamble. When we summarize the core insights of this situation, it becomes clear that the massive gulf between market expectations and corporate reality is where the entire story lives. The market looks at the 16-cent price tag and expects an immediate corporate death. The reality, however, is an incredibly aggressive, highly complex international restructuring campaign that has successfully wiped out millions in debt, brought the company back to positive equity, and aligned it with high-priority defense sectors. Yet this entire turnaround is funded by a diluted mechanism that actively penalizes common shareholders in the short term. The technology behind their high-power blue lasers is undeniably legitimate, but brilliant engineering does not automatically guarantee a successful equity investment. Whether you are using traditional platforms like Fidelity Investments or Interactive Brokers to manage an individual brokerage account, or exploring modern automated tools like Schwab Intelligent Portfolios, microcap companies undergoing a complete structural overhaul require absolute vigilance. The next few months will decide whether Nuburu successfully cements its position as a rising defense tech player, or serves as a cautionary tale of a technological pioneer swallowed up by its own balance sheet. This video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Bye. Don't forget to like, comment, and share this video to support the channel. Heart.